If you've ever wondered how these companies that buy all these massive commercial real estate properties do it and how the deals are structured, this video is for you. You know, what's interesting is most people assume that whoever puts up the most money into a real estate deal makes the most money when that deal does well, but that's actually not usually true. In many real estate private equity deals, the group that's only putting in 5 to 10% of the equity can end up walking away with 20, 30%, or even more of the profits. Now, how does that happen? The answer is the waterfall. And if you've heard about real estate private equity, you've probably heard terms like promote or promoted interest or carry or carried interest. And what these terms mean is it's basically an incentive structure for the person that's putting together the deal, to where if the deal does well, they get a promote, they get a carry, they get a outsized return for their strong performance of the deal that they put together. And so if you don't understand how the waterfall works, which the waterfall is determined by the promote or the carry structure, then you don't understand real estate private equity. So in this video, we're going to walk through it step by step, and we're going to use a realistic example to help illustrate it. So imagine you find an industrial property and you think it's a great deal. You really believe in it. And you start negotiating with the seller and you end up getting it under contract for $3.3 million. You talk to your bank and your banker says, hey, we will give you 70% of the purchase price, or about $2.3 million. We'll give that to you as a loan. And so that means you need about $1 million in equity or cash at closing in order to close the deal. And you don't have $1 million just sitting in your checking account ready to put in a real estate deal. So you start thinking about how you're going to get $1 million, and you start calling your friends and family to tell them about this awesome industrial deal that you found. And so at this point, you are stepping in as the general partner, or the GP. You found the deal, you negotiated the contract, found the financing through a bank, and once you close on the deal, you're going to oversee the leasing and the operations. You're going to deal with day-to-day issues that come up, and you're going to execute the business plan to drive value and make the investment a success for you and your investors. The people that are investing alongside you, hopefully your friends and family in this example, those investors are called the limited partners, or the LPs. They provide most of the equity. They take a passive role. They are not making day-to-day decisions, and they are relying on you as the GP to operate the asset. But before they commit capital to your deal, you're going to have to explain to them how the money is going to flow, or how the waterfall is going to be structured, and make sure that they are on board. And so how does this work? Well, you're going to start by explaining to your investors that if they invest in your deal, they're going to receive a preferred return. And so let's assume for this example that the preferred return you're offering is 8%. 8% is a common preferred return. It's normally somewhere in the 7 to 9% range. So 8% is a great barometer, and it's what we'll use for this example. So what a 8% preferred return means is the investors are going to get 8% a year on their money before you as the GP get any sort of promoted or carried interest. And so if you raise $1 million from your investors, that means $80,000 per year will be paid to them before you get any of the profits at your promoted interest. And your investors say, okay, that sounds reasonable. That's more than we can get having our money sit in the bank. And I think that's a fair compensation for taking the risk to invest with you in this real estate deal. But what about if the deal goes really well and the returns are much higher than 8% a year? And so you explain to them that once they get their money back and an 8% return for every year that the investment is active, then any remaining profits on top of that are going to be split 70-30. 70% to them, 30% to you. 70% to the LPs, 30% to the GP. And that 30% is called the promote, or the carried interest, like I've mentioned. And it's entirely performance-based. If the deal performs well, you can make a lot of money from your promoted interest. If the deal underperforms and you don't achieve above the 8% preferred return per year, you do not get any promote whatsoever. And so you've now explained the situation to your investors. They understand they're going to get paid first. They're going to receive an 8% preferred return. Any additional profits beyond that, they're going to get a majority of it, 70%, but you are going to get a 30% promote for profits generated beyond that 8% annual preferred return. And so you have a lot of upside, but you have to perform to earn that upside. And so they say, you know, we're willing to invest in the deal alongside you, but you need $1 million. We are only going to give you $950,000 because we want you to put $50,000 of your own money into the deal. We need you to have skin in the game, and you cannot go raise the $50,000 from someone else. You personally have to put your own $50,000 into the deal in order for us to give you the $950,000. And so you agree to put in the $50,000 and you're ready to go to closing. And so the capital stack looks like this. You've got a $2.3 million loan from the bank. You've got a $950,000 investment from your friends and family investors, and you've got $50,000 of your personal money that you've put into the deal. And so the deal is fully capitalized, you close on the deal, and the structure is an 8% preferred return, followed by a 70-30 split, and that becomes the waterfall. So think of how there's a waterfall, and the water flows down to different places. There's profits, and then the profits flow down to different buckets, and the preferred return and the promoted interest are what govern the rules for these buckets for the water or the profits to flow into. So years later, when you're ready to sell the property and you've added value by pushing rents, filling vacancies, making some improvements, and you find a buyer that's going to buy the property for $1 million of profit. And so for this example, we're going to keep the numbers very simple. You bought it for $3.3 million. You're selling it for $4.3 million. At closing, when the buyer pays the money, the bank loan is going to get paid off first. Then your investors are going to get their $950,000 back. You're going to get your $50,000 back. And then any preferred return that was not paid current during the life of the investment will be paid. And so to explain what I mean by that, the preferred return was 8%, as we discussed. And so if there wasn't enough cash flow in some years to pay that 8%, and it hasn't been paid in a later year, then there's going to be an accounting that takes place for preferred returns that were accrued and your investors were entitled to receive, and then how much preferred return did they actually receive, and any delta is going to be paid at closing. And then any profits remaining after the bank gets paid back, after your investors get paid back, after you get paid back, after all the preferred returns are paid, then your promote comes in. And so in this example, there's $1 million of profit left over after all those things are paid. And so 70% of that $1 million is going to your investors, and 30% of that is going to you. $700,000 to your investors, $300,000 to you. That is the 30% promote. That is the 30% carried interest. So think about how awesome that is for you as the GP. You only contributed 5% of the equity, but you're getting 30% of the profits. You only contributed $50,000, but at closing you got a $300,000 promote. 6x what you put into the deal. And what's even better is promoted interest or carried interest is taxed at capital gains rates, not ordinary income rates. And so not only did you make this huge bonus and get this huge upside, you're also going to have those dollars be treated very favorably from a tax perspective compared to ordinary income. Now, this is not tax advice. Check with your CPA, but that is how promoted interests are typically treated from a tax perspective. But remember, you only got this promote if the deal performs well. You only got this promote if you delivered for your investors. They got their 8% return a year, and you did so well, there was just a bunch of profits left over for you to distribute according to the agreed upon waterfall structure. If you didn't do your job well, if there were no profits left over after the preferred returns were paid, there is no promote, there is no upside. You did all that work for very little pay. And so let's talk about why this structure exists. And this structure exists to align incentives. Let's talk about who is doing what and who is risking what. Your investors obviously are putting their capital at risk. They are believing in you to take their hard-earned capital and earn a return on it. You are putting capital at risk too, just to a much lesser extent than your investors. But what you're really putting at risk is time, effort, and your reputation. If the deal doesn't go well, your reputation is going to take a big hit, and it's going to be very hard for you to raise money for future deals. And then the preferred return is protecting your investors by making sure that they earn a reasonable return on their money before you get this big upside. Your $50,000 co-investment ensures that you have skin in the game as well, and you don't have only upside, you also have capital downside, and your downside is not limited to just your time and execution and effort and reputation. And so the promote motivates you to perform at a high level and to make sure you are doing everything in your power to have the deal perform very well. And so this alignment and this basic structure is what makes the private equity real estate world go round. It's how operators raise capital, it's how investors deploy capital, and it's how portfolios scale. And so if you're investing passively, you need to understand this before investing money into a deal. How does the waterfall structure work? Is the GP's incentives aligned with the risk I'm taking? Do I believe in the deal? Are the underwriting assumptions the GP is presenting realistic? Do I believe in them? What is their track record? And if the deal does well, is the profit sharing waterfall structure fair and equitable? And if you're raising capital, you need to clearly understand this structure as well. You need to communicate it clearly and disclose everything to your investors. And you need to structure win-win, promote, and waterfall structures so that everybody is aligned. Your investors will give you money and allow you to grow your business. And if you own, lease, or are considering buying commercial real estate for your business, this is good to understand as well, because knowing how the owners and operators are compensated helps you understand their incentives, which ultimately drive their decision making. So that's the basics on how real estate private equity waterfalls work. And if you own or you want to own commercial real estate, or if you lease or buy real estate for your business, or if you're just interested in learning more about the industry or getting into the industry, be sure to hit the subscribe button and please send this video to anyone that would be interested in watching it. Thank you for joining. We'll see you on the next one.